Hello and welcome back. Today we'll talk about 1. Pips, 2. Lot size, and 3. Calculating risk. So let's get started. If this is confusing and overwhelming, don't stress too much about it. I mostly use price and percentages and have a method that will calculate the lots for you based on the percentage you want to risk. If you want to learn more about pips and use your own method in the future, I invite you to learn more about it. There's plenty of resources online. I'm a fan of KISS. Keep it simple, stupid. The simpler I can keep everything, the better. Then I can focus on the other things that will make me profitable. Pips stands for percentage in point. They are used to calculate the rates traders in the Forex market will pay. The value depends on the lot size you are trading. The currency used to open the account determines the pip value. For instance, on Euro USD and most of the other pairs we'll be trading, this pip is highlighted in green and the point is highlighted in red. Pip, point. You can see an example of Euro USD dropping 1 pip and the Euro USD then dropping 10 pips. This is dropping 1 pip. This is dropping 10 pips. Note that any pair involving the Japan's yen will be calculated differently, and there's more than one way to calculate, so I'm not going to delve into it to avoid more confusion and overwhelming you. I just want you to basically understand when a pip is mentioned, it's a refined unit of measurement for the amount of the currency you're trading in Forex. I hear many traders talk about how many pips they made on a trade, but that doesn't mean anything to me. Your ratio, like I got a 1 to 5, means something to me, meaning I risked 1% of my account and I made a 5% profit. That's a great trade and emphasizes risk management. When you just tell me I did 100 pips, that's nice. Just doesn't mean anything to me. All right. Number 2. What is a lot? A lot can be different for anyone. For instance, I eat a lot of apples. And what is a lot? I eat 1 apple a day. I eat 2. I'm just kidding. We're talking about lot sizes in Forex. And once again, it's a unit of measurement that's the same for everyone. Now that you're thoroughly confused, 1 lot in Forex is 100,000 currency units. Well, what the hell does that mean? If you buy a 0.01 lot of Euro USD with USD, or with the American dollar, you'll have 1,000 euro. If you buy 1,000 euro at the current exchange rate of when I'm making this video of 1.07310 with USD, with the American dollar, you'll have 1,073.10 in USD value. You're paying 1,073.10 USD for 1,000 euro because of the current exchange rate. There's also standard, mini, micro, and nano lot sizes. We're using the standard lot. I'm not going to go too in depth into this, but when you hear someone say mini lot, you'll understand it's 10,000 currency units and so on. In regard to lot size, I think it's important that you generally understand it, but really what is important is that you understand. The most important thing you need to understand about lot size is it's just the amount that you're going to put on what you're going to buy or sell when you make your order. And I'm going to give you a way to calculate this so you don't have to worry too much about the details. I think, like people say, the devil is in the details, but in trading, I think focusing too much on the details is where you find the devil, because you need things to be as the least amount of stress is the most important, I believe, in trading. So the less things you have to focus on, and the more you can just focus on your edge, the better, in my opinion. Number 3, Leverage. Now let's say you only have $500 in your account. How would you buy a 0.01 lot of euro on the euro USD? You would use leverage. Leverage in Forex is a way for traders to borrow capital to gain a larger exposure to the FX market. And by FX market, I just mean Forex. With a limited amount of capital, they can control a larger trade size. Risk management is very important with leverage because you can lose more than the value of your account balance. So just as you will win faster, you will lose faster. You are borrowing money. You can win more, and on the opposite side, you can lose more. I can't emphasize that enough. It's not just all sunshine and rainbows. When using ×3 leverage to purchase my position of $1,073.10 with $500, I'm going to lose more than twice as fast than if I bought just $500 worth. There's also a minimum lot size on orders, usually a 0.01, a standard lot. There's also apparently penny Forex accounts, but I've never used one and probably never will. Let's say your leverage is ×10 and your account is funded $500. With times 10 leverage on $500, you'd have $5,000 available for an order. You'd then be able to buy a 0.04 standard lot on euro USD. Euro would likely never go to zero, but say it did. You'd be negative $3,792.40. You'd get margin called before that though. Margin call is the notification which lets you know that you need to deposit more money in your trading account or lose closing positions in order to free up more margin. It's denoted as a fixed percentage which is determined by your broker and can be seen in the account specifications of your trading account. Your broker will likely freeze your account and sell or buy back your positions and freeze your account if you're unable to put more money in your account. Even if you're able to bring your account to a positive balance, you might have restrictions added, which has happened to me before and just isn't fun. And for me, it was a certain period of time that they relieved me of the restrictions. Slide 7. Hopefully I portrayed why risk management is paramount, which brings us to number 4, risk management. Always define your risk. If you're not defining your risk, you're not trading. You're just gambling. If you want to gamble, go to the casino. The way the casino makes money is they have an advantage. Even blackjack gives the typical casino a 1% edge mathematically, if you play perfectly. With the emotions of a player added in, they have a further advantage because the dealer always plays the odds. He has rules that he has to follow, and it's his job. Players don't have rules like the dealer. He's fired if he doesn't follow his rules. With a strategy you've defined, you have an edge and need to follow it. It also has risk defined for you to win based on the odds. You will need to learn to follow your rules like the dealer and adjust them over time by the supported data that you gather, never based on wants, needs, or emotions, especially in the moment. These risk-reward ratios aren't advice. I'm just teaching you how it works and why you'll use it. Risking 1%, you give yourself plenty of time for your edge to win over a period of trades in the long term, like a casino. With a 2-to-1 ratio, 1 win covers 2 losses. So if you trade 100 times and win half, you'll be up more than 50% because of compounding interest. Every time your portfolio goes up, the amount you risk and win goes up. I use percentage, and I don't worry about lots or pips. You can trade however you want. I use a system that calculates my lot size for me. I think the simplest solutions, as I've said before, are best. The less I have to worry about, the better. If you want to calculate it all out yourself, I'll give you the formula. You'll probably see why this is something I don't want to do, especially in the moment of every trade. How to calculate lot for order based on stop loss, percent risk times total balance divided by the stop loss times the dollar amount per pip if I buy one lot. There's many free lot size calculations you can find online too. So what I use to calculate my lot size is One Click Trade Pro. And I'll go ahead and show you the website. So it's on earnforex.com/metatrader-expert-advisors/one-click-trade-pro/ right here. Okay. Scroll down. Download. Okay. Just run through this real quick, just in case you don't know how to do it. So I'm extracting it. Then I have it here. Here's my expert. Then I would go to File, Open Data Folder. Was it? Okay, boom. And then paste it into here. Includes. Okay. And it has files and includes. So file, paste this one in here. Include, boom, paste these, boom, into there, done. And then to get it to show up, you would go to Expert Advisors, refresh, boom, it'll pop up, and then you'll drag it onto your chart. If you like how my charts look, I can give you the template for that. So let's short gold, short position, and let's do a 2-to-1. Boom. 2-to-1. So I'm going to go this. And I'm going to go. So I'm going to make, let's say I'm going to do a market order. Do a pending order, and then you can do a buy stop or buy limit, or sell stop, sell limit. So I'm just going to do a sell, and I'm going to take my profit, boom, profit, stop level, boom. Okay, recommended lot size 0.20. Okay. So it's already calculated it for me, and it's going to risk, let's see, risk percentage 0.50. And then you can go in here and you can set the default risk right here. So 0.5% I'm default risking. Okay. And then I lost my information. So re-put it, profit, stop level. As you can see, that's a lot easier, and I can get it done a lot quicker if I'm trading on the 1-minute chart. Okay, boom. So there we go. So I've risked, that's my stop loss. So if I lose, I'm losing 0.5% of my account, which my account is what, $98,000 plus. So I'm risking $484.80, and then my take profit would be double that, which would be $983.80. Okay, boom. That's it. It's pretty easy, and that's why I do it that way, so that if I'm on this 1-minute chart, I'm able to get my orders in quicker. Alright, so that's how you use One Click Trade Pro, and it's free. I believe it's open source, and I don't know if I called it my program. It's not my program. It is someone else's program, and it's freaking awesome, and I truly appreciate it, and hopefully me mentioning it and getting more people to go there will help out and get more people to contribute. All right, slide 9. Now we'll talk about avoiding margin call. This is how you calculate your margin call. This is how you calculate your margin level. In MT4, which we will set up in the next lesson, it's calculated for you. Your MT4 balance reflects the money you deposited, plus or minus any closed trades, if any. For example, if you open a trading account, deposit $1,000, and open the MT4 platform, your balance will show $1,000. Your equity is your total capital in your account at any given time, including the floating profit or loss from open trades. That's it for this lesson. Hopefully you've gotten some value out of this. Homework, I want you to reward yourself for making it this far. Take a moment to congratulate yourself, and if there's something small you can do, like eat a Twinkie or some celery, whatever your vibe is, do that. Next lesson, we start setting things up. Be prepared to hit that pause button on the next lesson while you follow the instructions. I also want to add, as I mentioned already, that we're going to set things up in the next video. So if you didn't quite catch the how to set up the one-click trade pro, don't worry about it. I don't know. How to set everything up so that you're good to go and that you have something highly functional that makes you comfortable and ready to trade. As I've said before, you want the most relaxed, less stressful situation possible, and that's exactly what I want to set up for you. If you found any value in this video, please hit the like button, subscribe, and share so that you can help others on their trading journey. And good luck on yours. Thanks. Bye.